word that you have got intention to spend the money. In this case, it's not so. What it says is that if you are not able to spend money, only explain it. That's what exactly it is saying. Therefore, there is a possibility that you may not spend. If you are not likely to spend, don't make a provision. If the possibility that you are going to spend, make a provision. That's all. A completely prudential practice. Yeah.
Is it not a statutory obligation to make a provision because you are anyway supposed to spend either this year or next year?
I am making this point. If the company fails to spend such an amount, the board shall in its report under clause O of subsection 3 of section 134 specify the reasons for not spending the amount. So there is no certainty that you will spend. When do you make a provision? When there is adequate certainty of that particular event to happen, then you will make a provision and to make the accounts true and fair. Here, there is a very clear provision available to you that you can avoid spending the money or you may not be able to spend the money. If you are not able to spend the money, the directors as a part of the responsibility have to tell the board that I am not able to spend the money. And there should be sufficient reasons for it. General body will question them, ministry will question them, so many people will question them, and therefore to be able to make a statement that I am not able to spend money is not that easy. It's a director's responsibility, people will be questioned. And in performance evaluation directors also it will come. You are not able to spend 2% of money also it will come. So the board of directors understand all this. So there is no provision which says, let us say in 2014-15 I have not spent 2%, I have to carry forward unspent money to next year. There is no such provision at all. So clearly speaking, if you are not able to spend the money, you have to explain and therefore you may not have to spend. But there is a clarity that there is a roadmap that you are going to spend the money in the next 6 months, though first 6 months you have not spent, make a provision. That's all I am saying. The next question is, XYZ is situated in a backward area. The company has constructed the roads near outside the factory area to provide access to approach the factory. Company has constructed other roads around the village, such as station road, roads connecting village to highway, etc. The company has also constructed public garden and has laid equipment which is used for exercise regime, building stamina, etc. The company draws attention to provisions of section 135 which state that CSR preference should be given to local areas and also to rules which say that activity carried in ordinary course of business will not qualify as CSR. In the light of this, whether expenses listed 1, 2, and 3 above will qualify as CSR expenses. For question number 1, reply is very clearly no, because I think the question itself says it's ordinary course of business only to improve your access you have done it. Therefore, question number 1 is not CSR. Question number 2, it may qualify as a CSR expenditure provided it's a rural in that sense of the term. If you, what is a rural? I don't think there is clarity there, but it's a rural area. Question number 2, expenditure will always be allowed. There's no problem in that. And then third one is slightly a grey area, because if you look at the schedule of events which CSR is allowed, preventive healthcare is one such entry allowed in the schedule. So will you consider the gym equipment etc. you put in the public garden accessible to all will be considered as a preventive healthcare? It has to be tested. If it can be demonstrated that it's going to be preventive healthcare matter, probably you can try to avail the expenditure. But if you are only giving to them some swings and seesaws, probably it will not come in. But if you provide a full-fledged gym, probably you can try to claim the expenses.
We are at 81 now, question number 27. 27 and 28 is broadly similar question, but I will leave it 27 first. What, as you know that those companies, certain companies are only required to go for rotational auditors. They are connected with the paid-up capital. And in this particular case, it has been stated that because it was having a paid-up capital of 20 crores, as on 1st April 2014, it was required to rotate with the auditor because the auditor had already completed its tenure of its tenure. So the proviso says that transition period is given, and during this transition period of 3 years, you are supposed to comply with the provisions. Now, what happens that during this 3 years, the question says is that the company reduced its share capital, let's say by buyback option. So it is now reduced to 15 crore and therefore below the required limit. Now the question is the company still required to go for rotation of auditors? Or is it that whatever was there on 1st April 2014, it is frozen? Now, if you read the section, it is possible to interpret it two ways. Is that in one way is to look at it that the particular situation was frozen. So situation as a first chapter that you see, was the auditor had he completed more than 10 years? The answer says yes. Then did the company have the required minimum paid up capital? The answer is still yes. Therefore, for 14-15 years, the situation was that you were required to comply, and then you were given a 3 years. Now the question is, in the next year the capital has gone down, or within the transition period has gone down before the end of that particular period. I think if you read section 139, what is the name? 132. What it talks of is that, see, if you read it, it's not that the situation is frozen. Every year you have to read this section and check whether the compliance is required of that particular section or not. So you will check two things. Has your auditor have having more than 10 years? Again, the answer will obviously be yes, he is having more than 10 years. In fact, his tenure is increased. Did he have the capital? And that condition also has to check during the whole transition period. Every time before you appoint the new auditor. In that particular case, when you see the condition is not complied with. So even if it was in the third year of transition period, just before the auditor's last appointment, if the shared capital had reduced and it had gone down below that limit, then according to me, the provisions of this section should not apply, and therefore the auditor can continue unless of course the capital is reduced or whatever. Then the next question is the other way around. The capital was already 15 crores as on 1st April 2014. So at that particular situation, although the tenure was more than 10 years, that particular section 139(2) did not apply. But during this transition period, let's say in the next 6 months after the first appointment, the capital was raised to 20 crores. Now the particular auditor has already completed 10 years. In the next year, is the first of all, does this section apply to such a company, number one? If it applies, then is the transition period available if during this transition period the share capital has increased? So that is an interesting question. I think the way I look at it is that, as I said in the earlier case, 139(2) you have to check every year. But if you read the proviso, which gives you a transition period, it says that you are supposed to comply with the requirements within these 3 years. Now, what are the requirements? Does it necessarily mean only rotation of auditors? In this particular situation, look at the situation is that the auditor is required to be appointed now, is required to be rotated. But the 3 years period was given to them by way of transition. It's a one-time transition period, is given as a relaxation. So therefore the relaxation has to be interpreted legally, and the wording used which are there is that you should comply with. Now so long as you comply with those provisions within that 3 years, then I think so in short, if your capital has increased, you do get this 3 years transition period to complete the thing. So suppose you have 2 more years, let that auditor continue and then complete. Now this is somewhere where I am maybe stretching a little and seeking a liberal interpretation, but it's a relaxation. It is a one time, this totally new law has come and you have to do a lot of things. So if 3 year transition has been given for existing companies, why not give a company who has slightly increased the share capital and just come into the condition? So I would answer that, say that yes, you get the full transition period.
This is again very interesting. The company engaged in manufacturing nutrition projects gives free coupons to the specifically identified NGOs to be distributed to schools of slum and rural areas. Upon production of such coupons as designated places in some specific stores, the students can purchase nutrition products of the company free of cost. The questions are: does such an activity qualify as CSR, or is it considered organic course of company's business? If considered as a CSR, can the company recognize the sale upon collection of coupons given purchases to the specified stores with corresponding debit to CSR expenses? I think it's a question is, the question that is raised is, I am manufacturing nutritious products and I am giving this to some people. Is it ordinary course of business? The point here is that I earn money, I give money for CSR activity. Is it qualifying? It is qualified. And you are giving away product instead of your money. That's what you are trying to do here. Therefore, the expenditure debits to your revenue by giving away products is acceptable as CSR. There is no question and doubt about it. But the issue is, what is the basis on which you are doing it? Is it given to generally uncontrolled number of persons through any other agency like NGO, or are you trying to experiment the quality of your product in a particular group, in a particular village? Let us say I adopt this village, give nutrition product. After 4 years, I write a report saying that we are supplied for 4 years in this area and all the youngsters are now very well nutrition. The nutrition levels have gone up. If there is a report you are going to give, it's a matter of advertisement. It's ordinary fruits of business. But then, if you are trying to say, I give it to NGO, NGO will control and decide as to whom should give this product to, and there's no company has no control whatsoever at all on the ultimate beneficiary of the nutrition product. Probably it can come as a CSR activity. I think, I don't know whether we should take such kind of a accountant view of this kind of activities. Hopefully the companies will try to open up their hearts. But anyway they want to spend money, let them spend with generosity instead of trying to make them tricks around it. That's what I think we should suggest these companies. So what I'm saying is, if it is control on the ultimate beneficiaries is not with the company, it is going to be given free away. It's not an experimentation for the purpose of future reports to return, etc. Then it can qualify as CSR activity. Mere fact that the nutrition product can be collected by giving a coupon will not take away the character of the scheme. Why am I saying this? For example, this nutrition product, whatever is there, has to be stored under certain particular conditions, let us say, temperature or whatever. That has to be given through, without getting faked, it has to be given through some credible stores. In that case, this coupon may be a good idea of saying that. NGO will go and give coupon and person will come and collect the commodity. And then we may want to stock it in so places, label, etc. So the process of giving a coupon will not take away the character of CSR, but intent will definitely hurt it. Intent, if it's not experimentation, intent is not advertisement, intent is genuinely given for the purpose of providing nutrition to some people generously, then it's fine, it can qualify as a CSR activity. Under miscellaneous questions, there are one question to me. A private limited company wanted to issue ESOPs to his employees. Private limited company wanted to issue ESOPs, okay, they didn't issue. Is this required compliance at 42 under section 62 of the Act along with rules? How company will comply with the requirements of 42, etc. 62 1B is attracted and not section 42 in this case very clearly. 62 1B talks about ESOPs. There is no bar on a private limited company giving ESOPs to the client, to employees. There is no bar on that. What it requires is it requires a special resolution to be passed. It should only attract 62 1B and not 42 at all. Therefore, the question related to 42 does not arise. Second question doesn't arise. You can give ESOPs to your employees. Only thing is, how do we try to give benefit of this ESOPs to the company is a question that we have to understand. Then you have to form a trust which will take the shares away, or company has to buy back the shares to provide the benefit to the employee of appreciation. So that's a different matter. Whether ESOPs can work in private limited company is a bigger question, but theoretically speaking, in this case only 62 is attracted and not 40. Okay, I'll take the question. Now. Okay, this is a question. This particular question says, as on March 31st, 2024, there are so many events which are say commercial paper loan 30 crores, loan from women's self-help group something, share application money, debenture issued by mortgage properties, optionally converted to debentures, loan from A. There are so many items. Let me go to the item by item now. What the question says is, what are the various complications arising out of the new act because of this particular financial stature of the particular company is a question to me. To the best of my understanding of this issue, definition of the deposit is very broad, and therefore item 3, 8 and 9. Item 3, 8 and 9 would mean 3 is talking about share application money, 8 is about advances from customers, and 9 is retention money for 2 years for capex, etc. They all will get attracted under the definition of public deposits as of today. The only advantage is that they are all before the date of implementation, and therefore we can take a view that since they are all prior period information, what we call activities, prior to the implementation of the act, we can take a liberal view here saying that they don't attract public deposit rules as of now. That's what we can say. But similar transactions doing now onwards will have a difficult situation. But in this case, the point that the saving grace in this case is the company is already accepting public deposits. Therefore, we expect that the company is in compliance with the other public deposit related rules, including limits, etc. And therefore, even these three are attracting public deposits rules, the company is not in any great difficulty because they are already complying with the requirements there. But if they had no public deposits at all earlier, then it's a different regime altogether. And then item 6 and 7 do not need any special treatment under RPT since they are past events. Again, I am taking liberal view. 6 and 7 deal with transactions with related parties. Loan received from A, who is relative of director X. Loan received from Y, a shareholder of the company. But again, I am taking view only because of the past period information. Item number 3, attract 40 to 6 about 60 days. Only saving grace is that if such issue is not under the new act and one can try to use that argument. That is, if you look at 3, you are talking on January 1st. Yeah, I think January has already explained this in great detail earlier also. Since you have taken on January 1st, 60 days are already over before the commencement of the act. So therefore, you are in a safe zone. But had it been March, situation is overlapping up to April. Nevertheless, the contracting point is before the date of implementation of the act, we can take the liberal view. But going forward, it will be difficult. But I don't know why lawmakers have not envisaged situations like allotment pending FDI, allotment pending approvals in SEBI and all. They are not envisaged. Why? Either they are expecting the efficiency of the government machinery to go up, or I don't know what. But then there are important things that we have got to live with. Questions are to me about. Thank you.
Excuse me. On the first, on the earlier slide, the share application money is also from a non-resident. Even if it is considered as a deposit after crossing 60 days, can we take an exemption that it is from a non-resident and therefore not a deposit?
I don't think so. If source of deposit will not matter, it's a matter of purpose for which you have taken it.
So there are exclusions in the deposit definition that any money taken from a non-resident is not to be considered as a deposit.
I need to read it. I am not sure.
I think you are right. That as I said in the earlier case, that if you have taken a loan, let's say from a company, then it is excluded altogether. Then it is a share application money or not. The same principle would apply. Any money taken from a non-resident, there is specific exemption. And of course, we are talking of Companies Act only. There is a provisions are there for prime and order, but that's a different situation. So, if you have taken money from non-resident, then it is not a deposit at all. So those provisions should not apply even after 2014. The question to me now next is question number 29 on page 82. Again, a very interesting question. As you know, auditors are now appointed for a term of 5 years, but so it's a balancing thing. That one thing is that the auditors should have comfort for 5 years that they will not pay more, so they have comfort of independence. At the same time, so as to not have totally no say whatsoever for shareholders, it is required that every year at the AGM, his appointment should be ratified. That is what the requirements of provision say. So what it has to be done is that every year, under section 139(1), the appointment of the auditor has to be ratified. So the question now is, what has happened is, a question which has been raised is that, let's say the shareholders do not ratify. So what will happen? Is it removal? Is it a casual vacancy? And how it should be dealt with? Now, first of all, just we all know this, but let me just again repeat what is the concept of ratification. Ratification is regularizing something which was irregular earlier. So if something was wrong earlier, like let's say there was something to be done by the board had the powers, but unfortunately managing director did it without taking the approval of the board. So he puts the matter before the board of directors. Board of directors says no problem, this was you have done in the interest of the company, we ratify that. So it is like making something regular which was possibly voidable. That is the definition of ratification. So in this, the word first of all ratification is wrong. But let's try to take up some positive meaning, saying that ratify, because this is important. Ratify means what? Either the word is you approve or you don't approve. Because based on that, the other question is suppose you disagree, suppose there are shareholders who come and say we don't want this auditor, and when the matter comes for appointment, they vote against it. That is not ratification or ratification. They have exercised their right to remove that particular auditor. But then the question comes, does it become removable? So let's come to that question later on. First is that is it in that particular case? So again, you have to understand what ratification involves. It means that the resolution would have been put before the shareholders, and it seems that the number of people who voted against it were more than the number of people who were voted for it. So that was what happened. So now the question that has been raised is it removable? Now I don't think this is removal, although it may amount to removal by the shareholders, because removal is specifically defined as a particular procedure for that, and removal is something broader. Removal can be before the terms. Ratification is at the particular AGM. Suppose I don't like the auditor, as soon as I appointed within 2 months I don't like. Whatever the reason, the auditor is bad or I am bad, whatever reason I don't want. So I go for the procedure of removal, and that involves central government approval and special resolution and all that. So this cannot be equated to removal, so this is not removal according to me. Then let us look, what will be the consequences of this? Is it a casual vacancy? According to me, casual vacancy, we had a concept of casual vacancy here. What the Companies Act 2013 is referring to something different. Now I will come to the rules later on which equate something to this, but generally casual vacancy is something different than this. Now let us look at section 139(10) also. What it says is very interesting. That if no auditor has been appointed. So what happens is that you had placed, suppose this is our annual general meeting and the appointment of auditor Mr. X was put here. You people did not approve it, so it did not got ratified. In that case, what has happened is nobody knew this was going to happen, so no other auditor was proposed. If some other auditor, you people had proposed, some of you, that we don't want this auditor, but we want this particular person, then you were required to give a special notice. Now, as per the query, that also has not happened. It just happened that you people did not approve it. In that case, let us read now section 139(10), which says that if no auditor has been appointed at particular AGM, the existing auditor will continue. So can we rely on that? If you go to the situation theory, yes, no auditor was appointed, so the existing auditor will continue. Now that is absurd, isn't it? The concept of ratification is that that person should be either continue to be allowed or not continue to be allowed. If it is not continue to be allowed, if you say section 139(10) should say that yes, the same person should continue, then it makes an absurdity of that provision. So let us take a view and say that also will not apply. Finally, we come to rule 3.7 of the auditor's rules, which I think deal with this, and see again, I don't know whether this question must have been raised earlier many times. What does the government have power to make rules? Can they modify the act? Can they give the exemption which are not existing? Or can they give clarification, or they can only merely, specifically provide only those to which it has been given powers to? Now there are two things. One is of course what you should be allowed to do, what the powers are. Then we can take a liberal view and say that yes, certain things where relaxations are given. Now this is again not fully true, but in case of relaxation, the rule-making power should be allowed. But it cannot create a fresh requirement, it cannot give a penalty and so on. In that case, here rule 3.7 says that if the appointment is not ratified, then the board shall appoint, the board of directors shall appoint a new director after following the required procedure. Now, they have not laid down law. So here I will import the requirement of casual vacancy, and in case of casual vacancy, it is said that within 30 days the board of directors shall appoint. So not in the question of resignation, but in any other case, let's say the auditor has died. So within 30 days. So I would say that no time limit is there. But if you apply and take a fair interpretation, then within 30 days the board should appoint another auditor. Now, so I think the answer to the question according to me is that it is not a casual vacancy, it is actually nothing. It is like no man's land. But this particular rule you can apply and say that that particular board should apply and ideally appoint the auditor within 30 days. Again, this does not leave everybody happy, because that is the concept of removal of auditors. And this is the way the auditor would be removed. So suppose he is a person becoming very uncomfortable. In the next auditor, see, there is no debarment of the promoters from not voting here. So even if the promoters holding the controlling interest as they usually do, at least at the AGM, the promoters will not appoint them, they will vote against it. So it is as good as removal. But still, I think somewhere a balance will have to be there, that since a view has been given to the shareholder, at least he is completing 1 year of audit, and to give the provision effect to that, maybe this provision can continue. And therefore, finally, I think the answer is that the board should appoint a new person. The existing auditor should not be allowed to.
It is not removed.
It is not removed. So I think that also comes to an end to my because question number 30 has been and 31 both have been dealt in great detail by Mr. Krishna. So I think all the questions are over. Thank you very much. I think the questions were very, very interesting.
One important notice of all the here. Listing regulations will come into effect very soon. Listing regulations. Listing regulation has got chapter 2 which talks about overarching principles. Overarching, second chapter in listing regulations is overarching principles. What overarching principles objectives, if you look at it, SEBI's debate paper or say the board note, SEBI board note which is available on the site, what it says is that in case they are not, in case of any doubt about any particular specific rule in terms of letter or word, or even when something is implemented by the letter of the rule, SEBI and exchanges are expected to interpret that event in terms of objectives of the particular rule, spirit of the rule, and therefore they can still take a view whether its compliance is full or not. That is, a lot of discretion has been transferred into the hands of the regulators under the heading of overarching principles. So my request to you people is, please read that when you are dealing with listed companies.
Just passing, since we are now relaxed, I'll just add to this. There's a curious decision of SEBI, which you may look it up. I don't remember the case now. I think I've written an article on that in the latest BCA journal. See, SEBI has interpreted, I'm just, with due respect, I'm just trying to slight different view on one particular point. Is that SEBI has taken a decision. The issue, I don't want to go into great detail. See, the issue before that was a controversial issue before the SEBI. It was alleged that certain people had violated the SEBI regulation, the SEBI before regulation specific. SEBI said that look at our FAQs. In our FAQs, we have given the answer to this. So law provides X thing. We have given the answer in the FAQs, the frequently answered questions. An interpretation the exchange situation should be Y. So he said you should have read the FAQs. And FAQs apply, and we uphold the FAQs, and they are binding on us. They are very much valid, and you should. That is the view. Now, I cannot understand this. SEBI is not a dictator or omnibus. What it says is not law. There is a SEBI Act. There are SEBI regulations. To pass the SEBI regulation, we have parliaments. SEBI proposes the regulations, it notifies the regulation, but for 30 days, they have to be reading the regulations. So SEBI cannot say that, okay, I have given this particular law. Incidentally, clause 49 is, I don't know whether it's already part or soon to be part of the listing, regulations. They are already part.
It's been approved by the board already. It will be notified in the gazette any time now.
So SEBI regulations are, once they become law. If you violate them, there are certain consequences. You can be prosecuted. So you cannot say that, SEBI cannot say that, okay, I have given this particular guidance to you, now you follow it. No, this is guidance only. Even if you read the FAQ, they have said they have meant only for guidance. So SEBI has taken an unfortunate view that my own FAQs will override the regulation. That is totally wrong. Some high court has to come up and throw it out. So SEBI cannot say that whatever I said is the law. RBI can say, if you read the RBI NBFC regulation, there is a particular provision for that. Even the Act gives it a lot of powers. And it says that whatever our view is binding and final and binding on the company also. But RBI is different. SEBI fortunately does not have such powers. So, I think we should not be so much. Unfortunately, it has taken such a decision. I hope it is reversed.
I have to add this here. Not from academic or anything. What I am saying is, many decisions which appear to be little arbitrary from this perspective, SAT is upholding them. SAT is upholding them, saying that SEBI can do it in interest. Last, if you look at it, last 1 year, 80% of SEBI decisions and SEBI education officers' views have been upheld by SAT. It's a very different situation. 2 years back, situation was not less than 20, not more than 20-25% of SEBI decisions are being upheld by SAT. The situation is just opposite now. Most of the SEBI decisions are getting upheld. And once it is upheld by SAT, it's very difficult for convincing the client to go up higher and up. So let us be clear about it. As practitioners, after all, we have to look at the welfare of our client and that's where the question is that conservative in the society. I am just bringing this listing regulations to your notice because something new which is coming up which has got an impact on us. That's the reason I am talking to you. Thank you.
Thank you very much, Dr. Nasiman and Zayan, for brilliant, I would say, exposition on the subject, in the sense that there was very clear-cut reply to all the questions. There was no if and but on any of the questions, and there was that shows the clarity of thought and mastery of the subject by both the speakers. Any questions you still want to ask? That we can have like 5 minutes couple of questions, otherwise.
Yes, there are two shareholders who are brothers and the same are directors. How to file the form for related party transactions? Both are related.
Yeah, I think there is one, I'm not able to recall the case law. You say Mukesh Bhai and these two, I mean, they're brothers, but in such case, they were not considered relatives for this purpose in a particular circumstances. I'm not trying to say being blood relatives alone will not make them actually the relatives in the sense of the term in all situations. Normally, yes.
If I can add to that, your question has been very well dealt with by one of the Jayant Bhai's write-up in BCAJ about majority or minority rules. I think that is in a great detail, exactly the same question.
Regarding section 160, can board recommend appointment of directors? Say for example, board has appointed additional director till and tenure is till AGM. So now is it necessary some member should recommend his appointment, or even board can do that?
It's nomination committee should do it. But I think finally the nomination,
Right.
formal
Right.
nomination has to be come by a shareholder.
Of course.
Because there is a deposit and all, there is a particular.
Yeah.
Yes. The board cannot, the board, as you rightly said, can appoint additional director. But again, that also has to continue at the next AGM. So at the AGM, if you are talking, then the nomination has to come from a member with the required procedure, deposits and everything.
That is the proposal will go from the company side saying on the basis of nomination committee's recommendation. The notice is sent to the general body saying that this is the person, this is the profile, this is the details of the person. Please pass a resolution. Resolution is placed before draft resolution is circulated. That's how it should be. Board by itself, only additional director can be appointed.
Loan taken from a cooperative credit society, will it fall under the exemption or will it be a default?
It will not fall. It is not a company, because unfortunately, just to give another example, LLP is also technically a corporate body now. Neither LLP nor cooperative credit society, unless it falls on credit society different. But suppose a cooperative bank and if it is there in that list and all that, then it will be exempt, but not cooperative credit society.
Thank you very much, my friends. Replies by Dr. Nasiman would be mailed to all of you. And Jayant Bhai also we have requested to give the replies in writing, and he has also agreed. So those also would be circulated. With one, either that they have their own views, so you could use it in the manner which you feel appropriate. And after this opens, this vote of thanks, there will be open session for 15-20 minutes. So I would request all of you to be please seated. And may I now request Jasmine Bhai to